For episodes ago, we lined up 11 different option strategies on one earnings night. Same stock, same expiration, and we made you a promise. We would not peek. We'd wait for the actual number, and then come back and see which one actually won. Well, the number is out.
And I have been dying to know. So no spoilers in the recap. Just tell me, did the boring, sensible strategy win, or did the lottery ticket win?
Oh, it's better than that. The result is so lopsided and so honestly counterintuitive that it teaches the single most important lesson in this whole series. Let's open the envelope.
Quick honest note before we dig in. This is just two curious people thinking out loud, for learning and for fun. It's not investment advice and never a buy or sell call, so always do your own homework. Before we do, the honest part one more time.
Always. This is education and entertainment, not advice, and absolutely not us telling you to trade any of this. Options can lose 100% of the premium, fast, and earnings are about as binary as markets get. Micron, ticker MU, was our crash test dummy for the mechanics. And to be crystal clear, what you're about to see is a board of outcomes, all 11 structures scored side by side. Not one of them was a real position, and none of them is the one we picked.
Just the scoreboard. The whole point was to watch the machine work.
Exactly. So let's watch it work.
Okay, what happened when the number dropped?
It was a blowout. Revenue came in around $41.5 billion against expectations closer to 36. Earnings were about $25 a share against a consensus near 21. And that beat even the whisper number, the unofficial but elevated bar the crowd had quietly raised to. Margins were huge, the high bandwidth memory was described as sold out, and then the guidance for next quarter was raised dramatically above where the street was.
So good news on basically every line.
Good news stacked on good news. And the stock reacted the way you'd expect. It jumped about 16% after hours, to roughly $1,214, up from around the 1043 we'd snapshot going in. Hold on to that 16%. It's the hinge the entire episode swings on.
Why is 16% the hinge? A jump is good for the bullish bets, bad for the bearish ones. Isn't that just obvious?
It's more than that, and this chart is why. Remember the implied move from episode 1? The options market had priced in a swing of roughly plus or minus 12% for this event. That blue band is the range the market was braced for. And the actual result, that green line, landed at plus 16. It didn't just go up. It punched clean through the upper edge of the band.
So the move was bigger than the thing everyone was paid to expect.
That's the whole game. Priced for perfection still wasn't enough. The beat and the guide were so far above an already lofty bar that the stock blew past what the options were pricing. And when the move breaks the band, direction stops being a nuance and becomes the only thing that matters. So here it is. Every structure we built, scored at that 1214 settle, biggest winner at the top, biggest loser at the bottom.
Whoa, it's almost perfectly sorted into pointed up and pointed down.
It really is. Up top, the synthetic long, the combo, gained around $17,000 on a single contract. Just beneath it, the humble long call, about 11.7. Then the defined risk bullish spreads and the straddle, all green. And down at the bottom, in red, every single strategy that was betting the move would be contained. The iron condor, the credit spreads. The market sorted them for us.
So the bulls just won. Mystery solved?
The direction won. But the really interesting lessons are hiding in the shape of this board, and in who lost, and by how much. Let's go through the 5 things this scoreboard is quietly screaming.
Start with the winners. Why did the unbounded plays win by so much more than the spreads?
Because the spreads have a ceiling, and the naked long calls don't. A bull call spread caps out. It made its full 6,500, and then it was done, no matter how high the stock went. But the long call and the combo have no upstairs wall, so when the move broke the band, they just kept climbing with the stock. Lesson 1. When the actual move beats the implied move, the strategies that left their upside open get paid the most, and every strategy betting against a big move lost. Direction overwhelmed everything else on the board.
So the times you most want unlimited upside are exactly the rare times the move is enormous.
Right? And that's also the catch, which we'll get to. Those same unlimited plays are the ones that quietly bleed to zero on all the ordinary nights. This was not an ordinary night.
Wait, what about for crush? You spent a whole episode telling me the number one force on earnings night is volatility collapsing and vaporizing premium. The long call is pure premium. Shouldn't the crush have heard it?
It did. That's lesson 2, and it's the subtle one. The crush absolutely happened. Volatility came out of every option the second the news was public. On a smaller move, that crush is exactly what sinks a long call even when you got the direction right. But here, the 16% move was so large that the directional gain completely swamped the volatility loss. The call made so much intrinsic value that losing the inflated premium barely registered.
So the crush only wins for the premium sellers if the stock stays inside the range.
Beautifully put. For crush is a tailwind for the sellers only when the move stays contained. The moment it doesn't, the crush is a rounding error and direction takes the wheel.
Okay, the part 1 find genuinely surprising. Look at the bottom of the board. The biggest losers aren't the wild lottery tickets. They're the credit spreads and the iron condor. The safe, high-probability stuff.
And that is lesson 3, and it's the one-eyed tattoo on a beginner's brain. The iron condor lost about 4,500. The bear call credit spread lost the most on the entire board, almost 6,000. Those are the high win rate strategies, the ones that quietly collect a little premium and win on most quiet nights.
So the strategies that win most often had the worst loss when the rare big move hit.
Win rate is not the same thing as safety. A strategy can win 9 times out of 10 and still hand back everything, and more, on the 10th. The credit sellers were picking up small, steady premium right in the path of a freight train. Most nights, no train. This night, the train came. Look at the condor's shape, with the result marked. That flat green plateau in the middle is everywhere it wins, a comfortable range around the starting price. And the settle line is way out on the right, well past the upper break-even, sitting down in the red.
So it wasn't even close. The stock didn't just nick the edge, it finished a country mile outside the box.
A country mile. And notice, the loss is capped. The line goes flat again at the bottom. It can't lose more than that defined maximum. Which, weirdly, is the hopeful part of this whole story, and it's the next lesson.
Hopeful how? Everything in red lost money.
They did. But look at how they lost. Every losing strategy on that board, the condor, the bear spreads, the broken wing butterfly, lost only its defined, capped amount. The most wrong you could be was known before you ever started. The butterfly, betting on exactly the wrong direction, lost about 3,200, and not a penny more.
So being wrong on a defined risk structure is
tuition, not ruin. A wrong call cost a known, survivable amount. Now contrast that with the one structure we deliberately flagged as dangerous, a naked short option, the undefined risk side of that combo. A bear short call into a 16% rip upward doesn't have a flat bottom on its chart. The losses just keep going. That's the difference between a bad night and a blown-up account. Lesson 4. Defined risk is what turns a wrong guess into a receipt instead of a catastrophe.
Show me the friendly version of a loss.
Here's the broken wing butterfly with the result marked. It was a targeted, cheap, convex bet, pointed at a totally different price than where the stock ended up. So yes, it lost. But trace the line out to the settle, it flattens. The downside is a small, fixed floor. That's a structure that was completely wrong about the outcome and still only cost its little defined debit.
It's almost relaxing to look at, knowing the worst case is right there on the page.
That's the feeling defined risk is supposed to give you. You can be wrong, really wrong, and still know your exact maximum the whole time. On an earnings night, that is not a small thing.
Is there a bigger picture takeaway hiding behind all this?
One more, and it's the most general. Going into a print like this, the options crowd is often heavily leaned one way, frequently hedged to the downside, loaded up on puts, braced for a fall. And when a surprise comes in hard the opposite way, all that crowded positioning has to scramble, which can actually add fuel to the move.
So everybody being positioned the same way is itself a kind of risk.
Consensus positioning is a risk. When the whole boat leans to one side and the wave comes from the other, the boat tips faster. It's worth remembering that what is everyone already braced for is a real question, because the painful move is so often the one almost nobody was set up for.
So if I zoom all the way out, what's the one sentence?
The market doesn't care what's priced in. A number can be a blowout and the stock can still rip, because expectations were already sky high and the result cleared them anyway. You can be right about the company and wrong about the trade, or wrong about the direction and saved entirely by your structure. Which is why, across this whole series, the lesson was never pick the winning strategy.
It was understand what each one is actually betting, and what it costs you when you're wrong.
That's the entire course in one breath. The tool you choose is a sentence about what you think will happen and how much you can afford to be wrong. This night just happened to reward the bulls. Next time it could punish them exactly as hard.
Give me the whole arc, then. 5 episodes.
Episode 1, the rules, the implied move, the crush, the master map. 2, the long volatility plays that buy the big move. 3, the short volatility plays that sell the calm. 4, the stock owner tools and the wrong tool for the moment. And tonight, the reveal, where a single real number graded all of it at once. The setup taught you the instruments. The result taught you humility.
And the humility is the part that actually keeps you in the game.
Every single time. The math is learnable in an afternoon. Respecting how wrong you can be. That's the part that takes a career. So if you remember one thing from all 5 episodes, every strategy is direction times size of move, refereed by volatility, and wrapped in how much you can survive losing.
Win rate isn't safety. Defined risk is a gift. And the market does not care what was priced in.
This was education and entertainment only, never advice, and never a position anyone held. Options are genuinely high risk. You can lose everything you put in, and earnings nights are binary. Thank you for sitting through the whole class with us, the setup and the final exam.
Same machine every time. Now you can see it working. We'll see you out there.
And that's where we'll leave it for today. Thank you, genuinely, for spending part of your day thinking this through with us.
The whole idea of this show is pretty simple. We hold a handful of theses about the world, and we test them out loud, together, a little more each day. No crystal balls, just curiosity and a willingness to be wrong.
So if that's your kind of thing, stick around for the next one, and tell us where we're getting it wrong. Honestly, the pushback is our favorite part.
Until next time, take care of yourself and keep asking good questions.